The idea that it could get to like 150,000 this year is still within our base case.
He thinks that the fear of May or the sell in May and go away will turn into buy in May. Tom Lee is managing partner, head of research at Fundstrat Global Advisors, as well as a CNBC contributor. What do you know about inflation that the market doesn't seem to understand right now? You don't think we need to be as hawkish as we are?
Yes. A lot of it has to do with why CPI has remained stubbornly high. Powell talked about it, that there's this residual lag associated with housing. So even though home prices are stabilizing and rents are actually getting back to sort of traditional rates of growth, it's still reported in CPI at close to 6%. And then the second piece is auto insurance, is what Powell calls non-housing services. Auto insurance is rising at 21%. Now, a lot of that's because auto insurance rates are actually jumping, but that's not going to keep going 20% forever. Once that starts to normalize, then you can think about what median inflation is, which is running at 1.8%. So I think inflation's going to sort of cool pretty dramatically. I don't know when, but it'll be sometime in the second half of this year.
I think you, maybe a couple months ago, you weren't quite as bullish. I'm not sure what your reason, but you came on and said it might be tougher going. And we did have a series of inflation numbers that were hotter than people thought.
Yes.
Did we not?
We did. I mean, yes.
You think that's not going to be the case as much from here?
That's right. I think going forward, a couple of things are better. One is like this job market isn't so red hot anymore. So I think the Fed's not on its heels as much about inflation could fall. And then I think that the things I mentioned, housing and auto insurance, are going to start to cool. So inflation prints start to look better. And we know that we had a big reset in April. So I think it looks pretty good for now.
You must agree, I guess, that the Fed right now is in restrictive territory, because I've been amazed at how the default position for Jay Powell has been for weeks and months that we need to cut eventually. It seems like the idea of hiking has never even crossed his mind, and he took it off the table again last week, basically. But it's weird to me, with the economy as strong as it was and inflation as sticky as it was, I don't know why that was his default position. He seems so sure. He's jonesing to cut rates. He really wants to, and the market believes him. And every time he says it, the market rallies and gets ahead of itself.
Yes. I mean, my sort of guess is I don't think the Fed's that comfortable with long-term rates at these levels. It is quite high. And as you know, it's putting a lot of pressure on regional banking. You know, I mean, it's really hurting their balance sheet. The cost of money is quite high, especially relative to the rest of the world.
And you think we are restrictive?
Yeah, I think it's quite restrictive, yeah.
And you notice whenever we return to, okay, we're still doing cuts, and then Bitcoin goes. That's all it takes, right? So you're still bullish. It's back to, I don't know, it was 50, I think it was at 57. It's back to 65 before you can blink.
That's right. I mean, Bitcoin's still, we think, early in an upcycle. So the idea that it could get to like 150,000 this year is still within our base case. I think it does help that the Fed is reiterating that its view on inflation and its being relatively dovish is more dovish than where the market is. So I think that's the process of why markets are recovering.
You know, one of the things Warren did was he trims this Apple piece. And I think underneath a lot of the language that he spoke about for 5 hours, there was some anxiousness about the overall economy. You don't have that anxiousness. What do you think of that?
I think if someone said, what are they anxious about? It is the fiscal deficit, the size of the deficit.
I'm not even sure he's anxious about that, though. I mean, he's anxious about that long term, but he was even asked about that, and that was not his issue. I think his issue was fundamentally, I don't want to put words in his mouth because he didn't say it. There's a lot of tea leaf reading, but just about the strength of where the market is right now and whether it's potentially overpriced.
I mean, he's steering a huge ship. So, right. You know, he has to think in longer term. But to us, earnings growth is accelerating. You know, Q1 earnings are up 7%, but, you know, 3 groups are down 20%, energy, healthcare, materials. Those energy and healthcare flip to positive next quarter, so earnings growth hits 11%. We know there's a lot of pent-up demand. Capital spending is picking up, and the ISMs are turning up, and there's $6 trillion of cash on the sidelines, and people have been cautious for more than 2 years now. So I think the risk-reward's still pretty good. I don't know if maybe Warren's lens is more 10 years out, and that's when you can be cautious, but I think the next year looks good.